So Marqeta went public last year at $27 per share and the stock has been absolutely smashed ever since, down by more than 70% from its all-time highs. The question is this a buying opportunity for investors? My name is Riado, and in this video, we'll do a deep dive on Marqeta, analyze its financials, and find out if we should buy ticker symbol MQ. If you'd like to read the article version of this analysis, you can find the links to my articles in the description below. With that said, let's get started. So Marqeta is a modern issuer processor, and basically what they do is they enable companies to run, build, and scale their own card programs using their open API, cloud-based, and easy-to-use platform. So to get a better understanding of what Marqeta really does is to understand what the payment ecosystem looks like today. So as you can see from this chart right here, there are basically 7 major parties involved in a typical payment ecosystem. So there's the issuing bank, which issues debit and credit cards to end consumers like us. The issuing bank also works with an issuer processor which connects issuing banks to the card networks, which are Visa, MasterCard, American Express, and so on. And if we look at the other side of the payment ecosystem, there's the acquiring bank, which is also called the merchant bank. The merchant bank is basically where merchants store and manage their funds, as well as to receive payments from consumers like us. So just like the issuing side, the acquiring bank also works with an acquirer processor which connects the acquiring bank to the card networks. So what Marqeta is doing is that they are disrupting the issuing side of the payment ecosystem. So as you can see from this updated chart, Marqeta is a modern issuer processor, and they help create modern card issuing and enables innovative card issuing programs. So with Marqeta, companies like Klarna, Square, Affirm, and DoorDash, they can start building their card program and issue physical, virtual, and tokenized cards to end consumers and even merchants. And the value proposition for these companies is that they don't need to work with issuing banks and the card networks, which can take a lot of time and resources to build that kind of relationship and structure. So what Marqeta offers is that card issuing infrastructure where they already partner with issuing banks and card networks so that these companies can focus on the consumer side, and focus on building their brand instead of dealing with all the back end stuff. And if these companies decide to instead work with legacy issuing banks and legacy issuer processors, that will take years to launch a card program, and it will take at least $1 million just to launch their own card programs. So Marqeta helps to streamline that process through its highly scalable, highly configurable open API cloud-based platform. So for example, DoorDash uses Marqeta to power its red cards for Dashers, and it allows Dashers to perform transactions based on a specific location, specific restaurants, specific time, specific orders, and dollar amounts, and so on. So it's very customizable and very rule based. So that is one of the unique features that Marqeta offers. Of course, there are many different features in its platform, but I won't get into detail as it will take a lot of time. But the point is, Marqeta is a modern issuer processor, and they're disrupting the issuing side of the payments ecosystem. So in terms of market opportunity, there's very little innovation and disruption in the issuing facing side of the payment ecosystem. If you look at the acquiring facing side of the ecosystem, you can see that there's a lot of fintech players including Adyen, PayPal, Paysafe, Square, and so on. But in the issuing facing side, Marqeta is the only fintech player in that space. The issuing facing side is dominated by players including Bank of America, Chase, US Bank, Citi, Goldman, and so on. So these are legacy financial institutions, and therefore there's a great opportunity for Marqeta to disrupt and innovate in that space. According to a Nielsen report, the card network generated $8.5 trillion of purchasing volume in the US alone. On the other hand, Marqeta only generated $111 billion of purchasing volume in 2021. So that means Marqeta only processed 1.3% of total payment volume in the US. So as I mentioned earlier, the card networks generated $8.5 trillion of total payment volume in 2021, which is a 25% increase from 2020 levels. But do note that Marqeta is growing much faster than the card networks because they're working with disruptive customers, including customers in the digital bank space, buy now pay later industry, crypto, on-demand delivery, corporate card, and expense management. They're also working with legacy financial institutions including JP Morgan, Goldman, and Citi. So I think Marqeta has a long growth runway ahead as they work with disruptive customers in these industries right here, and they also work with big tech and legacy financial institutions, which speaks volumes about the value proposition that modern issuer processors like Marqeta offers instead of legacy financial institutions and issuer processors. So now let's take a look at the growth numbers for Marqeta. Marqeta grew revenue to $166 million, which is a 54% increase year over year. This is despite a very tough year over year comps where revenue growth peaked in Q1 last year at 123% growth at that time. So showing a 54% growth in the latest quarter just shows how strong the platform is and how strong the value proposition is for customers. Revenue also grew 7% quarter over quarter, which was a very strong quarter because of the holiday season that we see in Q4. So again, this shows that Marqeta's customers are growing very rapidly and there's increasing demand for Marqeta solutions. Do note that Marqeta generates revenue through interchange fees. So let's say a consumer performs a transaction in a Marqeta powered platform such as DoorDash. Marqeta earns or generates revenue through interchange fees. So the business, which is DoorDash, they're charged an interchange fee, and that fee is split among the different players in the payment ecosystem. And in the case of this example, Marqeta, which is a banking as a service solution, they earn 0.5% of the interchange fees generated through that transaction. So therefore, the more transactions that Marqeta powered platforms such as Square and DoorDash and Instacart generates, the more revenue that Marqeta will earn ultimately. So if we look at the total processing volume or TPV that is generated under the Marqeta's platform, we can see that Marqeta processed $37 billion of TPV in Q1, which is up 53% year over year or 11% quarter over quarter. This is due to strong growth in two primary verticals, which is financial services and BNPL or buy now pay later. The outperformance of non-top 5 customers also contributed to the growth in total processing volume. As you can see, top 5 customers grew by 39% year over year in Q1, while non-top 5 customers grew 168% year over year. So this is a good sign because revenue or total processing volume will not be concentrated to just the top 5 customers that use Marqeta. For those who don't know, Block is the largest customer for Marqeta, and in 2021 Q1, they generated 73% of Marqeta's total revenue. However, due to the stronger growth in non-top 5 customers, Block's revenue concentration dropped from 73% to just 66% in 2022 Q1. So while Block's revenue concentration is still high, we can see that it's going to improve quarter over quarter as more customers join the platform and therefore contribute to total revenue. So all in all, I think the growth numbers for Marqeta is still very strong, still very high with 50% plus growth right here, despite very high growth in the early days of the pandemic. And as traditional banking and legacy financial institutions fall out of favor, I expect more customers to adopt Marqeta's modern solutions as it becomes more and more mainstream. Now turning to the profitability of the company, Marqeta generated $75 million of gross profit in Q1, which is up 50% year over year. Gross margin was 45%, which is slightly lower than last year's 46%, as well as Q4's 49% gross margins. During the earnings call, CFO Mike Milotich explained why this is happening. So he said that gross margins were lower due to a network incentive catch-up benefit we received in Q1 last year. As you may not know, Marqeta earns network incentives from the card networks such as MasterCard and Visa for hitting a new volume tier on the contracts that they have. And that contract runs from April through March. And in this contract year, Marqeta hit the higher volume tier 1 quarter earlier, which is achieved in Q4, and that is why Q4 has a high gross margins of 49%. And it also means that in Q1, Marqeta did not receive that network incentives. So they did receive in 2021 Q1 and 2021 Q4, which is why gross margins is much higher in those two periods as compared to Q1 this year. While gross margins look very healthy, we can see that operating profit paints a different picture. In Q1, the company has an operating loss of $49 million, which is a negative 30% operating margin. And this is because the company is reinvesting into growth, particularly in hiring new people. So as you can see, this chart shows operating expenses as a percentage of revenue based on the different operating expenses items. And as you can see, compensation and benefits is the largest item in operating expenses, which is around 50% to 75% as of lately. But do note that the company has very little sales and marketing expenses right here, which shows that the company has very high scalability potential in terms of growing their platform. So GAAP operating income includes share-based compensation, and if we adjust for non-cash expenses such as share-based compensation, we get an adjusted EBITDA that is provided by Marqeta. As you can see, adjusted EBITDA is much better than operating profits, but it is also still in negative territory, just fluctuating around break-even levels. This is because the company is still in its hyper-growth stage, and therefore the company is reinvesting all its gross profit dollars into growth. All in all though, I think Marqeta has high earnings potential as shown by its high gross margins of 40% plus. However, the company has not shown operating leverage just yet, as shown by its negative operating margins. However, this is because the company is reinvesting into growth, and I expect that to pay off in the long run. So therefore, investors can expect negative margins in the following quarters or even years because of the fact that the company is reinvesting into growth. So turning to the financial health of the company, Marqeta has $1.6 billion of cash and short-term investments with virtually zero debt in its balance sheet. So therefore, I think the company has a very strong financial position with a current ratio of 8 times. If we look at the company's free cash flow metrics, we can see that free cash flow margin has dropped from 35% plus in Q4 to just negative 29% in Q1. And I think the first reaction that most investors have is that, oh, what happened? What happened to the company? Why is it suddenly burning so much cash, which is a negative 29% free cash flow margin? Well, again, this is because the company is reinvesting into growth, and also management pointed out 2 items which caused cash flow from operations to turn negative. In the Q1 earnings call, CFO Mike Milotich said that 2 items this quarter that were very timing specific that caused cash flow operations to turn negative. The first item is paying out bonuses that were accrued last year, and the second item is paying upfront cash to a large partner of ours or a large vendor of ours to get a reduction in cost. And he ended by saying that if you remove those 2, operating cash flow for the quarter was actually positive. So therefore, I think the investors should not be too worried about this cash burn in Q1. And also, the cash burn is only $47 million, which is very small compared to its strong balance sheet and cash holdings of $1.6 billion. So I think Marqeta has a strong balance sheet, and I think investors should not be worried at all. Before we move on, I would like to say thank you for watching this video. If you like this type of content, please like and subscribe to my channel so you won't miss future videos, and it also supports me and motivates me to post more content like this in this channel. Now, in terms of the outlook of the company, Marqeta provided the following Q2 guidance. Net revenue is expected to grow 46 to 48% year over year. Gross profit margin is expected to be 40 to 41%, and adjusted EBITDA margin to be negative 10 to 11%. Now, just by looking at Q2 guidance, I know some investors might be feeling uneasy right here because revenue growth is slowing down from 50% plus to just 46 to 48%, and gross profit margin was as high as 45% to 49% in the last 2 quarters, which is gonna drop to 40 to 41%. And of course, adjusted EBITDA margin is expected to just stay negative, which is quite concerning in this current market environment. But management provided additional details during the earnings call to give some additional context to the numbers. So net revenue is expected to grow 46 to 48% as many of the drivers of outperformance in Q1 continues. However, Q2 growth is expected to slow down as the company grows over a larger base. So therefore, there's nothing bad that has changed fundamentally in the business, and the slowdown in revenue growth is just due to tough year-over-year comps. Q2 gross profit margin is expected to be 40 to 41%. This is due to Q2 being the lowest gross profit margin quarter as the network incentive contracts run from April to March, and therefore the volume tiers reset in Q2 of each year, resulting in lower network incentives. So that explains why management expects a dip in gross profit margins in Q2. However, the 40 to 41% range is still higher than last year's Q2 gross profit of just 38%. Therefore, it's showing that the company is achieving economies of scale. And Q2 adjusted EBITDA margin is expected to be negative 10% to 11% due to the gross profit dynamics explained above right here. The company is also ramping up investments, and that explains why adjusted EBITDA is expected to be negative. Management also provided its full year outlook. Revenue growth is expected to be in the high 30s based on the trajectory of the business year to date and expectations for new business contributing later in the year. Again, the slowdown in growth is due to the rapid scaling of the business that occurred last year, which is tough year-over-year comps. The company also expects full year gross margins to be in the low to mid 40s, consistent with their long-term guidance of 40 to 45%. In addition, the company expects Q3 and Q4 gross profit margins to be lower than Q1. And finally, adjusted EBITDA margin is expected to be negative high single digits as the company continues to invest in customer success and its global platform. So if we go to Seeking Alpha, we can see that Marqeta has been beating analyst estimates in the past 4 quarters as a public company. So therefore, with all the guidance that management provided, which is usually conservative in their part, we can expect the company to beat their own guidance as well as beat analyst estimates moving forward. Now, turning to the moats of the company, I think Marqeta has a technology moat. It is basically the first mover in terms of building a highly scalable cloud-based open API card issuing platform. The company also pioneered a few innovations including just-in-time funding and tokenization as a service. The company's technology is also proven for scale, and that is why a lot of the commerce disruptors today are partnering with Marqeta. That includes DoorDash, Instacart, Klarna, Affirm, Square, Brex, Divi, and so on. Digital banks such as Cash App and Coinbase are also working with Marqeta. And not only that, but tech giants and legacy financial institutions such as Uber and JP Morgan are also working with Marqeta, and that shows a lot about its technology moat that Marqeta has. Next, I think the company has a network effects moats. Marqeta has issued 493 million cards, and also currently there are 122 million active cards in circulation. And I don't want to sound like a broken record here, but Marqeta is working with disruptive customers including Square, Coinbase, and so on, which I mentioned earlier, and these are top dogs in the industry. They're not just some small player, and I think that will have immense network effects for Marqeta moving forward. And last but not least, I think the company has a switching cost moats. Marqeta offers an infrastructure for payment processing and card issuing to some of the largest businesses, and it's going to be very difficult for them to build in-house solutions or to replace it with another provider. And because infrastructures are very complex, customers tend to stay longer in the platform, and therefore they spend more in Marqeta's platform. In fact, Marqeta has very high retention rates of 175% plus in 2021 as well as 200% plus in 2019 and 2020. Now, turning to the valuations of the company, I think it's very hard to value Marqeta because it's a high growth business and it's just recently IPO as well. Enterprise value to sales multiples is about 5.6 times and gross profit multiples is at only 17 times. So I think given the high growth rate of the company and its potential, I think this is a very reasonable valuation at current prices. Back in June last year when it IPO'd, the company was trading at 100 times EV to gross profit multiples, which is very insane in my opinion. But however, the sell-off recently has provided a great margin of safety for investors and therefore a nice risk to reward potential here. And also CEO Jason Gardner's long-term performance award is very much aligned with shareholder interest. So as you can see, the performance award is divided into 7 equal tranches which vest upon the achievement of the following company stock price hurdles. So these are the stock price hurdles, and as you can see, the last tranche is $173 per share. So as you can see, this long-term performance award is set up so that CEO Jason Gardner is motivated to push its stock price all the way to $173. And based on current prices of $11, that is a 15x plus from today. And so yeah, I think this is one of the most attractive or one of the most shareholder friendly long-term performance award that I've seen from a public company. And even if the stock reaches the first tranche, we can see that it's still a 6x from current prices. So I think there's a lot of significant alpha that investors can create from investing in Marqeta. So now turning to the risks of the company, I think the first one is significant concentration risks. So if we turn to Marqeta's recent 10Q filing, we can see that there's a whole segment that addresses these concentration risks. We can see that there's a significant portion of the company's payment transactions settled through one issuing bank, which is Sutton Bank. For Q1 2020 and 2021, 86% and 94% of total processing volume was settled through Sutton Bank. And also the company has significant portion of the company's revenue derived from one customer. This customer, which is Block, accounted for 66% and 73% of the company's net revenue in Q1 this year and last year respectively. And also as of Q1, 2 customers accounted for 10% and 11% of the company's account receivable balance respectively. While concentration has been going down, we can't totally ignore the fact that 66% of the company's revenue is coming from Block. So if anything happens to Block, Marqeta will be severely impacted by that development. And the next major risk is competition. I think the company faces tough competition, including legacy processors like Fiserv. Marqeta also competes with legacy financial institutions, and even though some of them are Marqeta customers, they can start to build their own in-house solution, which will be directly competing with Marqeta. Marqeta also competes with other fintech companies such as Adyen, Stripe, which also happens to just recently launch their own card issuing solutions. Marqeta also competes with Galileo Technologies, which was acquired by SoFi, and they serve customers such as Robinhood, Chime, and TransferWise. But despite all the competition, I think Marqeta has a significant technology advantage as shown by the number of customers, large customers that are partnering up with Marqeta. So what is my overall thesis on Marqeta? I think Marqeta is one of the most exciting companies that I've come across as an investor. And I know exciting is not a good thing because exciting usually is expensive. However, I think the sell-off is overdone, and I think there's a nice risk to reward for Marqeta investors today. With that said, I think Marqeta is disrupting the issuing facing side of the payment ecosystem, and there's a long growth runway given that its customer base are all disruptors in their respective industries. The company also has strong technology, switching costs, and network moats, and that should support the company's growth in the years to come. In addition to the sell-off, I think the CEO long-term performance package is set up in such a way that it aligns with shareholders, and therefore I think it's going to reward shareholders as well. And if the CEO achieves the last stock price hurdle of $173 per share, that will be a 15x plus returns for investors today. As for me, I've been buying Marqeta during the sell-off, and it is now one of my biggest holdings and one of my higher conviction positions in my portfolio. But what about you? What are some of the highest conviction stocks that you have in your portfolio? If there's any company that you want me to cover in this channel, please let me know in the comments down below. Well, that's it for me today, guys. Thank you so much for watching this video. If you like this type of content, please leave a like, comment, and subscribe to my channel so you won't miss future videos. Thank you, and I see you guys on the next one.